Socialist Project Forum, Market Meltdown, Capitalism and the Crisis of Neoliberalism. Thanks to everyone for taking the time to attend this important event on the spectacular developments of the past few weeks. In North America, you're supposed to start with some humor. So I was just at a Chinese restaurant and I got a fortune cookie, and I opened it and it says, "You are going to have a very comfortable retirement."
In 40 years.
In 40 years. Anyway, I'm chairing this evening's meeting, even though I'm standing up right now, and I think I'll have a fairly easy job of it, at least as far as the introductions are concerned. Our speakers certainly need no introductions. We're quite fortunate to have Greg Albo, Jim Stanford, and David McNally with us today. All three are very busy people in high demand, so we're grateful to them for agreeing to speak at such short notice. So to speak not only at such short notice, but also to speak on the somewhat complicated topic we have given them today. A topic made all the more complicated by the fact that each day there seems to be a new round of unexpected, breathtaking, melodramatic, spectacular revelations about the depth of the crisis we're either living through or on the verge of entering. I'll leave the speakers to decide that. And our topic really needs no introduction either. It seems everyone is talking about the financial crisis that began with the American subprime mortgage mess in the summer of 2007 and has spread to the global banking system and the main stock markets. Just today, we saw historic falls on the Asian, European, and North American markets. And in an ominous sign, economists from Canada's Big Five banks today warned that we could be headed for something, quote-unquote, worse than a recession. We started to put this forum together just 2 weeks ago just after U.S. Treasury Secretary Henry Paulson had just declared the need for a $700 billion government package to bail out American banks. We didn't know, of course, that the intervening 2 weeks would see such a series of spectacular developments and pronouncements. We did know, however, that there was a real hunger out there on the left and in the broader public for explanation, analysis, and debate about what has been going on, and as far as we're concerned, about the implications for the socialist, trade union, and social movement left. I think this hunger has only grown more intense over the past 2 weeks, and obviously this evening's massive turnout attests to that. So without further ado, let's get on with the meeting. I think the order we decided on was Greg, Jim, and David. So Greg, Jim, and David will have 20-25 minutes each, and then we'll move into questions and comments from the audience. Then we'll give speakers time to comment further and to answer any questions that come up. Our goal this evening is to finish around 9:15, 9:30, and I hope I can recruit some people into helping move the chairs back into the neighboring room. Okay, so I guess with that, Greg Albo, Professor of Political Economy at York University and member of the Socialist Project. Over to you.
Thanks, Raghu. I began teaching in the early 1980s, actually, money and banking, maybe a long time ago. That was the first lectures I was giving were on money and banking, in fact, and I got sick of teaching it through the 1980s because it was just people going to Bay Street or whatever that I was teaching. I just got sick of it, and now nobody was interested. It was a hard time getting students initially. And now, of course, with the apocalypse, the financial apocalypse, everybody's interested in it again. So I went back to read my money and banking books over the last few years, and they weren't very good about describing the new world and all the changes that occurred. So I've been scrambling ever since and trying to keep up with many of the different aspects of it. My task here to begin this is partly to lay out some of the general broad themes, and then Jim and David will cut in at different angles. So I'm just going to lay out a number of issues and partly answer some questions about the currency crisis as I'm doing so, and where some of the debate about shifting power and so on might emerge from the credit crisis. The first point is, I think the question is partly to address is, what is the relationship between money, credit, and neoliberal capitalism? I think from this we must begin with Marx in the sense of the understanding capitalism as a system of capital accumulation where money is pursuing more money constantly, and all social classes are compelled to act in the market. We're dependent upon the market. This has given money a particular characteristic in capitalism, that is, it extinguishes and then reveals at the same time all the inherent contradictions of bourgeois society. It extinguishes them because we're all kind of made dependent upon money and a range of credit relations. At the same time, particularly in crises, it reveals all those things that there are inherent contradictions within capitalist society. Now, money has an incredible numbers of roles in capitalism. It's a unit of account, a store of value, the general equivalent by which we exchange. It's a moment in the circuit of capital. It's the institution of banks. It's the regulation and discipline of capital accumulation, the role that banks play in that. And of course, it's a social relationship. It defines social relations between us all. That's what money, banking, the credit system partly does. And then particularly because capitalism always forms itself as a world market, there's also been a linkage through money between different places of production and the social relations in those places through what we call world money, or the way that money's interlinked. Therefore, when a crisis, a financial crisis, erupts in one place, it has a tendency to spill over to other places. Seldom is it completely localized, particularly if it's a major type of crisis. It spills over and starts implicating social relations in a wide range of places. And that's clearly what's occurring now, where this credit crisis can't be contained within a portion of the American banking system, and surely not just in the US. When we think about money as capital, we also should try to get at the nature of contemporary financial structures. You need to separate out money as interest-bearing capital, that is, the advance of money for industrial capital to accumulate, and what we often call money-dealing capital, that is, the many forms that money takes so that you can advance credit in different forms to banks, to individuals, between different financial institutions, and so forth. What we have seen, particularly under neoliberalism, is a mass expansion of money-dealing capital, relative to interest-bearing capital, that is the role of money to advance credit to industrial capital. As well, we have various forms of speculative or fictitious capital, which is forms of capital, money capital, which are speculating on the future, on the uncertainty of the future. Now, particularly today, we've seen a huge expansion of those forms of speculative or fictitious capital. That is, those capitals that share out risk on the basis that we don't know what's coming in the future. These are the forms of hedge funds, the different roles that are played by the way that insurance companies have changed, the way that all financial institutions are engaged in mass speculation around currency movements, and all these other forms of complex derivative markets that are characteristic of this period. Now, within capitalism, you also must think of a money capital as always dominant but dependent. That is, it's dependent upon industrial capital and its accumulation for the interest, etc., that it earns. But it's dominant. That is, it plays a dominant role in deciding where the surpluses that are made in capitalist society, where they go. So it plays a major role in disciplining all the other institutions of the market. At points in time, not only is financial capital dominant in terms of relative to industrial capital, it's often sometimes hegemonic, meaning it also is providing political leadership over the general political direction of that society. In this period, you have to think of financial capital not only as dominant vis-a-vis industrial capital, but also hegemonic in the sense of providing political leadership and deciding and figuring out what is pushing where the state should go, defining the interests of capital, and so forth. It's been playing a major role in that. Now, the final thing I want to say about these initial points is that financial markets tend to breed always new claims and tradable assets. That is, they form, particularly when they're unregulated, they find various niches within accumulation, within financial markets to breed new structures. And we've seen that in this period, particularly the way that financial markets have spread, and some of their structures have changed in pension funds and exchange markets and futures markets and new kinds of money markets, etc. So you have this massive new forms of financialization, which are relatively new in their specific content to this period as opposed to over the general history of capitalism. Now, none of these relationships that are in money markets are purely technical. You'll see on the paper all the time or on the TV that the discussion is if interest rates are some magical technical figure. Magical technical figure dealing with the rate that capital should be advanced to industrial capitals, or the way that we should arbitrate between different types of forms of money taking or different types of loans. In fact, all interest-bearing capital, all money capital are fundamentally a political relationship. There's nothing rational, as Marx said, in what an interest rate is. It's an irrational form. That is, it doesn't have a direct relationship to surplus value. It's an irrational thing. So therefore, it's dependent on a whole range of circumstantial settings and particularly power relations. Power relations between different blocks of capital, and power relationships between different peoples and social classes. And therefore, the question of banks, interest rates, money, because it is characteristic of a social relationship, banks are playing a role in disciplining the capitalist market, and interest and the flow of interest plays a crucial role in where the flow of surplus goes. All the issues related to money and banks are deeply, deeply political in capitalism. And they raise, as I said at the beginning, all those questions about extinguishing and having inherent in them all the contradictions of capitalism. That's what money and banking is, and that's partly what's present exactly in this credit crisis. It's trying to make us all claim that we're all in it together. As you could see, the way that that was put forward by the bankers, etc., and the Congress. At the same time, it's quite revealing of all the inherent contradictions of bourgeois society at the same time, the way that some people are salvaged and others not. I think the final point, this general point I want to make, is that the nature of money capital, and particularly the way that it breeds speculation and risk-taking and trying to forecast the future, I mean, it's an incredible breeding ground for fraud. You can't but read the history of banks or money and know that it's a complete breeding ground for fraud. And you can imagine the stupidity, the incredible stupidity when we implemented the absolute stupidities of Hayek in some notion that we should have self-regulation of the money markets. Completely crazy. And no doubt we're living probably through some of the biggest structural frauds, structural meaning inherent in the entire way that the money markets and financial markets have been working in history. There's just no question. You can see if they do any investigations, one after another, the financial houses would crumble on the basis of the frauds that are inherent in their operations. I just want to quote two things from Marx on this to underline the points I said. As Marx put it in terms of money capital is the common capital of the capitalist class. That's why it plays this kind of role, and banks play this role over capitalist society. He also said about it, looking at the banking system, the enormous centralization of the credit system gives to this class of parasites the fabulous power not only to periodically despoil industrial capitals, but also to interfere in actual capitalist production in a most dangerous manner, which is exactly what we're living through. And then he said, all capital seems to double itself and sometimes treble itself by the various modes in which the same claim on a debt, which is particularly the expansion that we're seeing, appear in different forms and different kinds. And that catches exactly what we partly lived through, this capacity of money capital to play a role in the expansion of production and the scale of production, at the same time breed enormous speculative bubbles and particular kinds of crises that we're living in. Now, the neoliberal capitalism of today, neoliberal globalization, has compounded all those inherent contradictions of money, because we're now dealing not with a money form that is backed by any commodity such as gold or silver. It's what we call pure credit money or fiat money. That is, it also is backed by a sovereign state. And therefore, there's nothing that controls the growth of money. It can multiply itself, particularly inside the banking sector, it can keep multiplying. So we see that the credit claims are massively, extravagantly large relative to the production of new value added. Now, new value added being produced each year, is going up at 3 or 4%. I don't even know what the numbers are, but it's incredible the amount of paper claims that have built. Jim used, of course, for his well-known book, Paper Boom, to describe that phenomenon. And its inherent aspect, and what's unique about this crisis, is that it's fiat money that has allowed this expansion to grow so large, okay, relative to the growth and the new value added that's going on, and why then the crisis can be so uncontrollable, and why we could have difficulty unwinding it at all. Okay. Secondly, what is the basis for this crisis?
That was just first me?
Yes. First question. What is the basis for this crisis? I think when we look at this crisis, you don't see it on the TV or on the newspapers, but we've got to think of this crisis located in terms of class struggle and intercapitalist competition. And it emerges out of the class struggles of the 1970s and 1980s in a particular way. Particularly that it emerged out of class struggle as an attempt to restore profitability, roll back working class unions, parties, living standards to restructure capital and restore profitability. And that still is a critical dimension to the problems of today. This meant, and I'll follow through a series of steps here, meant the widespread of wage and social austerity. Wage and social austerity meaning we've been pushing real wages down since the late 1970s, and we've been spreading social austerity throughout society through the cutbacks in the public sector. This was coupled with systematic forms of industrial restructuring, that is, re-engineering the corporations through maybe shifting in space, upgrading their technology, and so forth. In this process, there was a new role for banks, and that banks began playing a much larger role in this restructuring process, and they played a large role through credit money, and they played a large role in demanding discipline. They were aided to this by the international financial institutions about the restructuring process and the role of demanding discipline. At the same time, the processes of restructuring lead to, and building new plant and developing new places of production led to increased competition between firms, between countries, between regions. And this launched a systematic form of what you can call competitive austerity. That is, increasing competition coupled with social and wage austerity as the central dynamic in the economic system. This normally leads to a problem of where then will effective demand come from. That is, where have all this productive capacity has been expanded, where will the consumers come to deal with this, to consume those particular goods. In this particular period, that was found especially from the United States. The United States providing the central source of effective demand. And from the 1980s on, the U.S. began running very large current account deficits. And they were doing this by extensive military spending, government deficits, and throughout this period, particularly in the last 15 years, by mass consumer spending. That mass consumer spending partly coming from the profits and other forms of income being extended to the professional and ruling classes, and from workers because of the austerity going in more and more into debt, either on the consumer side, through consumer side, or on the mortgage side. This meant also, with this new form of credit money, that the U.S. was putting dollars into the international system that was then being held by other countries, and they began recycling those dollars back into the U.S., lending the U.S. the money to consume the goods that were largely being produced, were starting to be extensively produced elsewhere. This, in the late 1980s, but throughout, or late 1990s, but throughout, was then met with additional financial deregulation. This allowed banks increasing leverage in the financial markets. That is, they began to leverage their relatively stable loans or stable investments with more riskier investments through time. The leverage ratios went from below 10 to 1 to now they're often 30 to 1, 40 to 1. So in other words, banks' balance sheets started reflecting inside them the role of all these forms of money-dealing capital and forms of speculative capital. Financial crises, because of this form of money, have been consistently characteristic of the period of neoliberalism going back to the 1980s. In the late 1997 and 1998, there was two big shocks. The long-term capital management crisis, an initial speculative fund that collapsed, and also the Asian crisis that spilled across many of the Asian markets. There was also a major crisis after 9/11, the sharp slowdown, sharp drop in stock market prices and a slowdown. And this, each time, was met by very sharp declines in interest rates, being pushed down to try to reflate the economy. If you're holding these kinds of money and you're looking at interest rates going down to zero or giving you negative returns if you're just borrowing treasury bills or very risk-free assets, you're not earning anything. At the same time, you've blown up and made everybody more dependent on different kinds of financial assets. All the funds that are holding then these speculative assets start looking for places to put them, right? They start looking for where you're going to get better returns. So they started meeting with more risky investments that were being also offered in terms of credit markets and especially in mortgage markets. You get higher returns in the mortgage market, right? And therefore, this money was also flooding into more speculative markets systematically. Now, this clearly led to the boom that occurred from 2000 on in real estate markets as these loan structures started expanding. The ones in the U.S. were of course called the ninja loans, the no income, no job loans. To the most vulnerable in Canada, we had a different variant. We've had a different variant of that, which has been recently shut down, which is 40-year mortgages with no down payments. Those have been largely closed down. This led to very, very large price bubbles. So by the last few years, we've had then in place all the forms that are necessary, right, to lead to a credit crisis. That is, money in the form of credit that is expanding enormously. It's financializing itself everywhere. Investors are looking for more speculative or higher returns, so they're willing to take more risky, go into more risky zones. Consumers or working class people have restraints on their income. They're looking for loans to try to maintain their standard of living. This develops then the conditions for a speculative bubble. The question then is simply, what's going to trigger that bubble? And that's the third question I want to answer, is what caused this specific crisis? And I'll just walk through what exactly occurred. Immediately, if you can imagine, with any kind of economic slowdown that has occurred over the last few years, and people taking on these kinds of loans, you're immediately going to hit by forms of personal bankruptcy. Personal bankruptcy then starts spilling over into housing crisis, with housing not being sold or people foreclosing on their housing. This will lead to a housing price decline, which means the economy would further slow as construction slows in the housing sectors. Of course, then the first thing that's going to occur is the most speculative mortgage dealers that were only 6 months before being featured on the front pages of Business Week or the Times as the most innovative business people of the moment, are all of a sudden insolvent. Countrywide, etc., that were being celebrated in the business pages start becoming insolvent. They go bankrupt. This will then spill into what we call the prime dealers, such as occurred at the beginning of summer at Bear Stearns, a prime dealer of money in the money markets. And initially what will be hit is their most speculative funds dealing with mortgages. So a year and a half ago, the Bear Stearns Structured Investment Vehicle Fund that deals with mortgages went bankrupt. Okay. And that started putting pressure on Bear Stearns to start addressing its own particular problems. That leads to the next step. You have to then try to deleverage your balance sheets, and this can spread into a wider liquidity crisis for financial firms. That is, you've got to unwind your more speculative investments, try to get some money for them so you can pay the people who want their loans back. When this starts developing into a liquidity crisis, the larger brokerages in mortgages become insolvent as well, as particularly as the housing prices decline starts continuing. This is exactly then what happened to Fannie Mae and Freddie Mac, and we held a seminar about a year ago with a number of people, and this is what we thought might unfold if there was a continual decline in housing prices, and it did. As a result of that, there's more deleveraging as liquidity and insolvency crisis, that is, general problems of people being able to borrow start meeting insolvency crisis or bankruptcies, and become self-reinforcing, and the bubble then systematically starts deflating in a way that nobody can control. And that's what we've been living through in the last 3 or 4 months. That was the result of led to the crisis of Lehman Brothers, Merrill Lynch. It's also what led to the insurance companies such as ANG, which, like all financial institutions, didn't stay providing insurance, but also went into derivatives markets. And as this is linked on a world market, it starts spilling over into other markets. So you then have had bank runs in Asia, Europe, and so on, spreading and encompassing the whole system of capitalist production. Right now, we're in an additional stage from this crisis. What we're now in a stage is that money markets have seized up. That is, the banks no longer trust lending to each other. In other words, their lending rates to each other are going up, and still they don't lend to each other. The central banks are trying to find ways to force them to lend by driving interest rates or playing that role, but in general, money markets have seized up, which has also meant that the places that industrial capital now borrows from, which is where they try to get short-term loans or 90-day loans, sometimes longer in the commercial paper market, that is seized up. So in other words, you're now dealing with a spillover from the seizing up of money markets, right, into a general economic crisis, or sorry, a general financial crisis, or the question of systematic failure that people are talking about, that are being discussed. That is the stage we're at, and that's what is trying to be combated. The next question, of course, which is the speculative, whether this will lead into a wider economic crisis, and whether that economic crisis will be a recession or a depression. Quite clearly, it would seem to me that the seizing up of this will certainly lead to a recession. It then raises the question of a crisis of neoliberalism. Obviously, we'll deal initially in this period of an attempt to reconstruct neoliberalism. It's whether it can be reconstructed. There's a question of whether it will spill over into a crisis of the world order and U.S. power. Quite clearly, it's within the realm of possibility that the countries and zones that have been lending to the U.S. for a long period will form something like a creditors' cartel, which is the possibility of a bloc forming in Asia, and therefore demanding some different kind of structural access to the American market, which will then involve certain modulations of power. And then, of course, there's always in these moments the crisis of capitalism. And to answer that question really is asking a question about how we address the crisis of the left and whether there's an alternative political agency that would challenge things at that level. Thanks.